Welcome to Fidelity Soundbites, a monthly podcast where investors can tap into Fidelity's more than 400 investment experts who are on the ground around the world so that you have the inside edge when it comes to making more informed investment decisions. From equities to fixed income to private assets, let us help you build a better financial future.
Welcome, my name is Lukasz, and I'm pleased to be joined today by Gary Monaghan, Head of Investment Directing for Asian Equities. Welcome, Gary.
Thank you for having me.
And then today, look, we're going to be talking about all things Asia, and it has been quite topical because there's been a lot happening in that market. But maybe if we start off very sort of big picture, and one of the things obviously a lot of investors are thinking about at the moment is inflation, and really at the crux of that is what's been happening with the oil price. We've obviously had issues in the Middle East, Iran, oil price going up, fluctuating. And one of the topic areas is how different markets will be impacted and certainly how Asia will be impacted. Interested in your sort of take in terms of what are the key risks, which markets may be impacted more than others from an Asian perspective?
Yeah, I think it's first of all key to say that Asia isn't facing a collapse, but high oil prices, is not the greatest thing for the Asian economies. They are big net importers of energy, as you're aware. India, the ASEAN markets, are key importers of oil, so they will be largely disproportionately impacted. Of course, you've got markets like China. China, yes, does import oil. It also gets its oil from other parts of the world, maybe potentially Russia and others. But it also has a lot of renewable energy, coal reserves and so on. So therefore, it's relatively immune. And then moving over to other parts of Asia, Korea and Taiwan, again, importers. But actually what we're seeing there, and we'll get onto tech I'm sure a bit later, is that the earnings growth has been really strong, getting a lot of revenue growth coming through, and is somewhat masking potentially higher energy costs at the corporate level as well. But overall, it would be nicer to have lower oil prices for Asia, and it depends on how long this goes for as to how that will impact. And if we do not get a resolution anytime soon, and we get higher, oil prices are well above 100 for a prolonged period of time, you can factor in a relatively tougher environment from a cost-based perspective for a lot of Asian economies and its companies as well. But I should really point out that it's about also the corporate level who has pricing power, who can pass these rising costs on to end consumers or customers and who can't.
It's interesting if we sort of then think about the market itself and you think about Asia, and one of the key elements at the moment is the level of concentration in that market. I mean, there's parts of that market that have gone absolutely gangbusters. I mean, a lot of the narrative globally is around the Mag 7, US and the concentration there, but it feels like Asia is almost like a amped up version of that. So what are we seeing in Asia with respect to concentration, and what are investors really getting?
Yeah, absolutely. You are seeing incredible amount of concentration in Asia. As you just said, you've got the Mag 7 in the US. You've really got this sort of Mega 3, Super 3, whatever you want to call them in Asia, with TSMC, SK Hynix and Samsung just absolutely leading the way. And actually what we've seen is the oxygen that's fueling the share price rallies there is actually taking the oxygen away from the rest of the market. And just looking at the numbers, looking at the index returns at sector level for Asia ex Japan, the IT sector in Asia has done 160% in the last 12 months. The market has done 40%. Every other sector, industrials, consumer, financials, etc., has underperformed. So it's been really very much a market of you're in some of these semiconductor names and you're an absolute hero, or you're not and you're lagging behind. There's an issue of omission, but then everything else that you own is just not keeping up. So therefore you are seeing this concentration. What does that actually mean? And what does that mean for not just returns, but risk profile is really important. And just taking the index as it is today, if you're looking at ex-ante volatility as a risk metric, more of an absolute risk metric, a year ago, the IT index accounted for about 30% of the total risk. Okay, that's acceptable. Today, the same index, the IT sector takes up about 70% contribution to total risk. So therefore, just because of the market moves, we've got this now outsized risk composition from the IT sector and these three stocks in particular. What it means is if you're a passive investor, okay, you're getting the market return, but actually you're not possibly getting a risk-free market return. You're getting a very concentrated and possibly lopsided return profile from a very small handful of stocks. Active managers obviously don't have to be there. And so therefore, if And when this rally broadens to other parts of the market, you should see a lot of the unloved, untouched areas, which is pretty much everything ex-tech, get a bit of love again, and potentially some of these mispriced opportunities can catch a bid again.
Yeah, it's a good point because for a lot of investors, obviously, if they're thinking about Asia as an investment, they're one of looking for growth, but also there's an element of diversification. So the point you make around, if the market is, really being driven by a couple of tech stocks, and then you've got, your broader global exposure, US exposure being very much driven by the similar dynamic, it's a challenge for diversification.
It is. It's like a all eggs in the one basket sort of scenario at the moment. And that, unfortunately, is the dilemma that I think investors, our clients as well, are facing. What will make the party stop? The thing is, you don't want the party to abruptly end because everything will probably get pulled down at the same time as well. And of course, you get winners and not from that. But you're looking for any signals that could signal a pumping of the brakes on the tech sector rally that we're seeing. And if we see that and money proliferates across the rest of the market, that should be a good spot for us.
And if we sort of delve a little bit deeper into the tech theme and specifically around AI and semiconductors, because that's really been the big story in Asia. There's been a couple of big winners in those areas, both from a company perspective, but also geographically in terms of which countries have really sort of benefited from that in Asia. I mean, I guess your observation in terms of that broader theme, in terms of AI and the CapEx cycle, specifically in terms of some of these Asian companies, can you just give us a bit of a sense of what your views are on that?
Look, first and foremost, Asia is really the backbone of the global AI sort of infrastructure build-out that we're seeing. So the US hyperscalers are pledging capital to build, the cloud business and data centers and so on. That's great. Then it sort of trickles down the chain, and the guys that are producing and supplying the components, are largely in Asia. Again, your SK Hynix, Samsung, TSMCs, amongst others. And I should say this rally that we've seen is not a rally on a whim and a prayer. This rally is actually largely driven on good companies actually producing things that people want and generating earnings. It may be a case that the expectations of this continuing for a prolonged period of time may be a little bit hyped up at the moment, and hence maybe a bit of the bubble needs to just deflate slowly from where we're at. The other thing to point out, though, is that this has been an earnings cycle. It's not just a sentiment cycle, but the tech industry is at its heart still quite cyclical. And I think one of the key risks that we're looking at the moment with the tech sector in Asia, probably beyond as well, in other markets too, is that what is historically a cyclical industry is now being almost considered as a long-term linear structural growth opportunity. And that's where we think the risk lies at the moment in terms of market sentiment and views.
So from a portfolio perspective, and if we sort of delve down into how we're structuring our Asian portfolio, how are we managing those two things? One, that you've got this, this really strong momentum trade at the moment. Anything that's linked to AI, semiconductors has just been performing really strongly. And how do you manage that on the total portfolio level in the context of our portfolio?
Yes, so what you've seen is, as you said, the tech momentum is strong, and we have been underweight, and that's hurt. But you sit there and you also think the underweight got quite significant. The momentum party was continuing to go on, and could this go on for a bit longer? Yes, is the answer. You can sense that through, again, the buying of domestic investors in markets like Korea and Taiwan, and the expectations for earnings. Whether you agree with them or not, you still know there are earnings that are coming through. So that sort of momentum can continue. So you take a view that, okay, let's narrow the underweight. Okay, we might not want to be fully there because of the risks that not being factored in by the market. But at the same time, you don't want to be missing the boat completely. And so therefore, we've reduced the underweight. And you see that in our tech exposure. Absolute terms, the tech exposure is a lot higher than it was a year ago. But we still remain underweight, although less so than we were even 3 months ago from here. So what that means, ultimately, if we get the tech sector continue to rally, we'll still get some decent absolute return. If the tech sector starts to roll and it goes to other parts of the market, from a relative perspective, that should be beneficial to us.
And if we think then from a broader portfolio perspective, obviously the tech sector is very dominant, key part of the Asian market. But beyond that, what are some of the areas beyond the tech sector that you are looking at, investing in? How are you getting that diversification?
China is a market that we're finding interesting opportunities. So you should think China and plus Hong Kong. It's a market that still doesn't get very much love, and we think that there's a lot of mispriced opportunities there. There are companies that are generating decent earnings growth, but they're just not in this sort of AI semiconductor space, and so therefore getting no bid whatsoever. And as I said, there's no oxygen in those names, but we think looking ahead, as the market proliferates and looks for elsewhere, the companies that are generating earnings can really boost portfolio returns. You're looking at stocks like Tektronix, power tool manufacturer. They make Ryobi tools, Milwaukee tools, which I think are sold through Bunnings here in Australia. This is a company that's seeing earnings growth. We're seeing margin expansion coming through. We're seeing through R&D and customer relationships that they've built. They've now got power tools that are linked to data center building, infrastructure projects, and your general sort of DIYers as well. But, in the market's mind, they just make drills. And so therefore it's not exciting. But look at this. This is a company that trades at attractive valuations. As I said, earnings growth coming through. For us, that's a really, really good business that you want some money in. And we think we can make some decent returns in a 2-year view from here.
And interested actually also in your thoughts on India. It's a market that sort of comes in and out of favour over time. What, if any, exposure are we looking at in the Indian market at the moment, and just overall view on India?
Yeah, overall view on India, as we mentioned at the beginning, India is one of the economies that could face a bit of a challenge if oil stays higher for longer. So whilst we're sat here today, valuations look more attractive than they did 18 months ago. They're much more compelling versus history, versus other markets. Earnings seem to be stabilising, which is great. There's general policy support. We've seen income tax cuts, seen some rate cuts coming through. Again, all great. But if oil stays higher for longer, that's going to hurt the consumer's pocket. Ultimately, in India, your average consumer, a lot of their disposable income is used for energy and food cost. And you get these inflationary pressures that has a real impact on everyday life. Beyond that, you've got the adoption of AI. So an AI bot is now, being considered as something that you can use for your coding and for your tech build out if you're a business. And what impact does that have on the IT services industry, which was considered a growth engine for future development in India? That's a challenge. And if you think as well, the way you've got a lot of younger demographics coming into the India market, lots of people looking for jobs, previously would have been potentially in those tech jobs, which maybe don't exist anymore. So where does the next middle class come from? So India's got some of its challenges, which we'll need to overcome. Valuations, as I said, more compelling. That looks okay. The policy support is there, but oil and the potential issue in the services sector are something that you really need to consider. What do we look at and what do we own? We have about 11% of the portfolio in India, a little bit in banks, like HDFC banks. We've been trimming that, but still in there. And Axis Bank, seeing deposit growth coming through. They're really, really well managed businesses. More recently as well, we've opened a position in Titan. It's like a jewelry retailer, like watches and other jewelry. It's an industry that's very fragmented, and we think there'll be some consolidation there that they can really benefit from going forward. But relatively smaller positions in those, just given some of those risks that I talked about.
If we look out for the next sort of 6 to 12 months, what would be your top 3 recommendations to investors looking at the Asian market?
I think in no particular order, I think be very aware of the concentration risk and just make sure you're not too tied up in overly concentrated parts of the market. There are other good companies out there that potentially maybe offer really good value. So don't just chase what has already done well. I think China could be really interesting. It's a market that has been off everyone's radar for quite a while. It is investable in our view, and there are a lot of really good companies that are churning out decent earnings growth at attractive valuations, and it's a market that could very much catch a bid if we get a broadening out of this Asia rally that we've seen. And thirdly, I think be very stock specific on companies that offer pricing power. As we talked about right at the beginning, oil prices seems to be higher for longer from here. And that could really create a higher cost base for a number of companies. So look out for businesses that have got brand strength, that have got incredible manufacturing capabilities and real pricing power that they can pass on to customers and maintain margins.
Thanks, Gary. Look forward to speaking to you again.
If you've enjoyed today's episode, make sure to subscribe to Soundbites on your favourite podcasting platform. Otherwise, if you'd like more information on Fidelity or Fidelity products, please head to our website at fidelity.com.au. Now for some important information. This podcast is issued by Phil Responsible Entity Australia Limited, AFSL number 409340. This podcast is intended as general information only, has been prepared without taking into account any person's objectives, financial situation, or needs. You should consider the product disclosure statement and target market determinations for Fidelity Australia products at fidelity.com.au. Please click the link in the show's description to read the full disclaimer.